At this time, I would like to introduce Jack Kleinhenz, Chief Economist for the National Retail Federation. Please join me in welcoming Mr. Jack Kleinhenz.
Well, I'm delighted to be here this morning. Thank you for inviting me. Actually, it's the first time I've been to Kansas, and I hail from Cleveland, Ohio, although I am with the National Retail Federation out of Washington, D.C., and it kind of reminds me of a story actually going to Pittsburgh for the very first time. I was being recruited. I was at the University of Notre Dame teaching in South Bend, Indiana, and I was go Irish, right? So I flew into Pittsburgh. I was brought to the Federal Home Loan Bank, and I was being interviewed to be chief economist. So as you know, with these interviews, you're going to be there all day, and then at the very end, they say, thank you, we'll put you in a taxi cab, get you back to the airport. Well, before I got in that taxi cab, the then CFO said to me, Jack, what's 3 times 7? And I'm thinking, there must be something hidden in this question. Now, if you were an accountant, you'd probably say, well, what do you want it to be, right? But on the other hand, I just blurted out 19. Well, Chuck France said, thank you, Jack, we'll get back to you. Well, 2 weeks later, I get the call from Chuck and says, Jack, we'd like you to come back to Pittsburgh because you need to meet with the board of directors. And I said, oh, this is really fantastic, Chuck. I guess I got the job. He said, well, you'll get the job after you go through the board of directors. And I said, well, this is really interesting because I know what 3 times 7 is. It's not 17, it's not 19, it's 21. He says, Jack, don't worry about it. We interviewed 13 other people and you came the closest. And I think it's only important to really make that comment today because we're talking about economic forecasts. And Jeremy and I do put a lot of effort and time into thinking about how the economy works. It's complicated and it's not easy. And we put together forecasts, we use models, and we put out our forecast. But I think it's not the number as important as the important thing is the assumptions and the input that goes in. And as I hope today that I provide you some guidance and perspective on the economy, and I'm going to first talk a little bit about the national economy. And by the way, strap yourself in. I'm going to move fast. I've got a number of slides I'd like to get through and to share with you. And I want to especially look at retail. And as I mentioned, no forecast is accurate. It's the assumption. So think through some of the comments that I will make. And let me start off with this analogy. If you noticed my graphic, I have puzzle pieces. And I like to think about the economy as sort of a jigsaw puzzle. And, at the top of the box, we're trying to put these pieces together. And I'm going to argue today that we have the corners and the sides and a lot of the pieces in the middle figured out, right? I mean, I think the economy looks a lot better today than it did certainly in 2007 and 2009 when we didn't have any idea what the top of the box was going to look like because the pieces were upside down. We were going through a very, very difficult time. So think about it in that perspective. And to frame my discussion, I'm going to first start with some data that comes from the National Association of Business Economists, overall a survey that was released just a week or two ago. And I'll get to this slide till the very end, and just to keep things moving. So I'm going to look at the U.S. economic outlook, consumer household spending. We won't spend any time on investment, but I'll make a comment, we'll look at inflation, and we'll wrap it up. But if you look at this first slide, the economists are out there trying to make predictions. And back in 2013, we thought the economy would produce about a 2.6% increase in GDP. And then we came out in March, right before the data on GDP came to tell us that the economy went down the drain in the first quarter. And then shortly thereafter, in June, we came out trying to tweak our understanding, and we thought the economy would be a little bit less, 2.5, and then you kind of go in a little bit further and you start to think about, so what's happening here? Well, long and the short of it, our forecast right now from the National Association of Business Economists, which I just left our annual meeting last week, is for a growth of about 2% for total for 2014, because we have to take into account the very slow first half. But to think about it from that perspective, we're getting some traction. And going into 2015, our most recent estimate is about 2.9% vis-a-vis about 3.1% not too long ago. So it's about the same. It's very close for government work, as we say. Now, the range of economists are out there. There's about 55, 60 economists that are in this survey, and you can see that there's some very optimistic people and some still pessimistic individuals. And the top range is around a 3.8% growth, and the bottom range 2.3%. Now, looking at it from a quarterly standpoint, you can see we're looking for some stable growth going out into the next year. Quarterly growth somewhere around that 3% GDP, okay, which would mean for consumers, in my view, my estimate was going to be somewhere in the range of an increase of consumer spending of about 2.3, 2.4%, which is what we're seeing right now in the economy as we're finishing up 2014. What about inflation? Our expectations for inflation are very important as we make decisions about what we produce, how we produce it, for whom we produce it, and, from a consumer, what we purchase. And certainly, you can see that the inflation rate that we've seen in this, I gotta look my line is drawn to the left of the blue bar. It should be to the right, because anything to the red is forecast, so you could figure that out. You're smart people here in Wichita. And so, inflation has been up. And the real question right now is, especially from a monetary policy, is, will this stay? And what are the elements that would cause the price level, whether it be the personal consumption expenditures, core PCE, you take out food and energy, or whether you look at the CPI? That's a good question. And it looks like, especially with gasoline prices coming down right now and oil prices coming down, that's probably going to be the case. And so maybe our estimate for PCE and for the CPI might be a bit high at this point in time because, we don't really know how the oil forecast will be. If you can tell me what the price of oil will be, and then we can figure out how much the price of gasoline will be. And you can back into, well, that'll probably translate into this type amount of spending. So in terms of employment, another key variable, this was a week ago last Monday, we had a large increase in the number of individuals that are employed, somewhere in the range of, I forget the number already, but 248,000 if I'm not mistaken, and this was sizably larger than what everybody had expected. And then going out for the next 12 to 14 months, my colleagues have forecast about a 200,000 job increase on a monthly basis. And what does that mean? Well, you got to remember that there are always new people coming into the marketplace. So the number of potential individuals looking for jobs has to, be absorbed by jobs if you want to keep the unemployment rate just the same. But what we're seeing is the unemployment rate has been declining. And so we're seeing sort of a more normal activity of having job growth of around that 200,000 to not only provide jobs for those people coming in, but also to taking other people off the unemployment rolls. Now, I know there's a lot of numbers up here. Let me just focus on a couple of them, and you'll have the slides, and you can, reference them for yourself. But again, as a backdrop for what I'm going to say in the next few minutes, I have to have assumptions about how the economy is going to be looking. And so as I think about 2014, we've suffered through the polar vortex earlier this year. We haven't had certain obstructions like we had last year, especially at this time of the year. If you remember, last year we had increased income taxes because we changed our tax code a little bit in terms of our rates. Then we had, the debate on the debt ceiling. Then we had the shutdown in Washington, and then we had, this, unusually very difficult winter weather that impacted not just retail, but, the overall economy. So those things were really, truly impacting the performance of 2014. If we could, get rid of a few of those shocks, it would have been certainly a little different trajectory. But what I want to point out here is that in the forecast, we see consumption, personal consumption by you and me about 2.3%, and that's kicking up to 2.8%. That's the median forecast for the 65 people that put this forecast together. And I think it's a little high, but I'm going with something around the 2.3, 2.5, which is where my forecast is going to be coming out on. Then business fixed investment. Now notice in 2013, structures was only 1.3% growth. This has been sort of the missing link in some cases. We haven't had the spending for business investment in structures, and it seems like it's picking up. Why is this important? Why is it important from a retail standpoint? Well, because when you start building structures, when you see construction getting some traction, we'll start to see more jobs and we'll see spending, because those are all very good jobs, as we know. I understand there's a building going on here in the Wichita area, which is creating spending power, certainly jobs. And then we've been having good growth in equipment and software. So I guess this is the point where we're hoping that the economy starts to get back to a normal recovery expansion, because typically in recoveries and expansions, we see housing and investment taking a lead in many ways. And housing is residential investment. And notice what's happened. In 2013, we had a 12% growth. Now we're down to 2.7% for 2014. Hopefully getting back to 9.2%. Why is that important for me is looking at the retail from the consumer. Well, there's a lot of retail spending that goes on when people are making home improvements, or when they're building a new home, or when they're selling a home, right? You replace carpeting, you replace appliances. There's all the things that go along with it. So the housing industry has been very important from a retail standpoint. And as we all know, housing kind of got us into this mess, the housing finance, and the way we're going to see it I think going forward is to help us in a normal way, hopefully going forward, to help us lift us out in the next couple of months. Now, I've already mentioned about core PCE, so you take out energy and food, and we're seeing our forecast to be around that 1.6, 1.7 on average. 1.7 is the forecast by my colleagues, 1.9. I'm a little skeptical. I think that because of what we're seeing right now with oil prices, that maybe we'll see that a little lower. Then finally, a lot of people ask me about the stock market. Well, I find forecasting the stock market to be very humbling. So I don't. So I'll give you these estimates. Of course, yesterday's S&P was off a little bit, wasn't it? And then Dow closed at 1968. So for those financial persons in the market, in attendance here, we're looking at about on air 2020 by the end of this year, and 2117 by the end of next year. So continued growth. Okay, so let's get into where I spend a lot of my time, and that's consumers and household spending. The growth in the economy since the recovery has been, on average, about 2.3% since June of 2009. Most of that growth has come from consumers, as you probably are aware, and they make up 70% of the economy. And 1.5, 1.6% of that overall GDP has been contributed by the performance of the consumer. So in terms of retail sales, as the chief economist, and really the only economist, by the way, at the National Retail Federation, hey, you go for it, right? And I had to put annual forecasts together. My annual forecast back in January is for a growth rate of 4.1%, and that was before the first quarter data came in. So we waited until we could get, the understanding of also what was happening in the second quarter. I scaled back my forecast from 4.1 to about 3.6 for the year, and that makes a lot of sense, certainly because of what happened. Consumers still continue to be very selective, price sensitive, and cautious. And we will see, and we continue through the holiday season, and we'll talk a little bit more during the Q&A about the holiday forecast, because we just released ours yesterday. And, the day before yesterday. That promotions and discounting, we have conditioned consumers to look for these kinds of opportunities. So those won't change, in my view. Now, in terms of personal consumption growth, what's been holding off consumption? There's been kind of a conundrum from my perspective that nominal personal income has actually been growing about 4% on average for the last 3 months. But consumption's been off. Why isn't it higher? And we asked other colleagues to answer the question, and of course it says weak personal income growth. Well, I can observe that. I can see that. But why weak personal income growth? Largely because wages and salaries haven't moved, comparatively speaking, as we have seen in past recoveries. In the last recession, back in 2001, actually wages and salaries continued to grow during the recovery. It didn't stop, and that's what's happened here. And there's many theories about what's happening out there. One theory is that wages and salaries aren't growing because many businesses didn't cut wages, but kept the people on. And so they have to sort of wait to see productivity and more demand before they're going to be able to push on wages to provide that. So we'll see. I don't know how people think about that. It's the big issue in Washington, and big concerns by everyone about how do we get the economy moving faster again. In terms of retail sales, last month, August, was a very strong month. Actually, the red bars here that I'm showing is the year-over-year growth just for that particular month, okay? So, it's erratic, not surprising. And then monthly sales is the blue line. And so if you look at month-to-month sales, we had a very strong month in August. It was about 0.5%. And part of this, I believe, has been helped along with lower gasoline prices. And indeed, low inflation has actually kept consumption from disappearing. One other thing that I'd mention to you, because I'll say it again, maybe I won't need to, but during this past summer, I don't know how your summer has been. I understand it's been pretty warm around here right now, but it was an unusually mild summer across the United States, so utility costs were down. So from a consumer standpoint, there is a little bit more disposable income that would be available because they wouldn't be having to pay so much as they did the year before when it was a very warm summer, as you recall. Major impact in agriculture and the drought, et cetera, that occurred. So as we look at the last few months in terms of consumer sentiment and retail sales, somehow my line didn't come out on this. For some reason, you don't really see consumer sentiment moving. But let me tell you, it's been up around the 80 level mark. Not where it is there. That line that should not be there. Up around 80, and it's been hovering in that area, and it's kind of difficult to interpret. The consumer sentiment, as the University of Michigan Reuters index is put out. And then if you look at retail sales, the 3-month moving average, we see what's happened. Look at what's happened since the first quarter. We've seen some positive acceleration, if you will. And so as I look out going into the rest of the year, I think this will help us move along the line as we think about spending in September, October, November, and December. September data won't be out until next week. We have to always wait for a lag. I get a lot of questions about e-commerce, especially in retail. And so how are people spending their money? And using the internet has certainly been a big feature of modern day shopping. And about $75 billion in e-commerce were spent in the second quarter this past quarter. And that's about a 4.9% growth on a quarter-to-quarter gain. And when you start looking at it as a percentage of total sales, that's that red line that I have here, you can see that it's still got a long way to go. A little bit under 6.5, 6.2%. So it's here. The question is, will it continue and take over retail? I don't think so. I think brick and mortar is still a very key feature of the business of retail. Okay. Jeremy asked me to think about, well, what factors influence consumption? And this is how I think about my modeling efforts. I look at disposable income, the value of home and investments, personal savings, access and use of credit. What's my ability to spend? What's my ability to spend? Okay. Then I have to think about, well, what's my willingness to spend? Just because I have it doesn't mean I'm going to spend it. Well, that's not, my 5 kids think otherwise, of course. $20 doesn't go like it did when I was a kid. But on the other hand, consumer confidence is important. The job outlook, inflation, all of these are very important as we think about how consumers, how shoppers will get out there and spend. Let's first look at recent developments in income, wages, and consumption. As I mentioned, consumer contributed about 1.5% of total GDP for the last several years, 5.5 years, since the recovery began. Now, in September, we saw consumption, excuse me, I stand corrected. My numbers are August. We'll see September's number at the end of October, so we have to wait a few more weeks. But we saw consumption for August up, which was compatible with my retail sales number, and wages and income patterns are starting to rise a little faster, and you can see that with the red and the blue lines. And this has been sort of the missing link that we've been all talking about. What about wages and salaries, and how do we see people thinking about what their expectations are? And it's also the key to Fed raising rates. This is where the Fed will focus in on. To what extent might there be inflationary bias that will come from wages moving faster than other activities in the economy? So when you see sort of the speed of wages and salaries really picking up, that'll translate into perhaps a tighter labor market. So think about it to that extent. As we get tighter in terms of certain markets and certain sectors, you'll have to pay a little bit more to attract and keep that labor. And that's sort of the normal activity of the way the economy works. And we just haven't seen that happen, largely because this recession that we had has continued to stay on in a much milder recovery and expansion that we would have otherwise seen. Now, credit outstanding is a very important part. I call it the flywheel to the economy, whether you're in business or whether you're in a retail standpoint. We need credit. We use credit. Credit in just the other day, we got new data that just came in, was up considerably, and non-revolving credit is the largest part of it. The non-revolving credit is for purchase of longer-term assets like a car or furniture that you might finance, versus revolving credit, which would include your credit cards. And credit cards actually have been, the use of credit, revolving credit has been moving up, especially in the last few months. And we did see this last year, and it usually occurs sometime also around the holidays, as people, want to basically, hey, I need to, don't have the cash today, but I'll get on my credit card. But what's been very evident is that the consumers won't keep those outstanding balances like they used to. And there's a number of reasons. First of all, they might not have the credit limit that they used to have. And secondly, they're afraid. There's still a concern out there, continues to last. We got the employment number last week for the month of September. And it showed certainly some strength of the employment, rose 248,000 total, including government, and private, we got 236,000. I think my graph is also a little dated because Jeremy was much a taskmaster. I had to turn everything in. I couldn't come here with my little plug-in this morning and say, hey, here's what I'm going to talk about. He wouldn't let me do that. So I'm afraid my data, but anyhow, you don't need to look at my data for this. I'm sure he has it on his website. I know he does. And so the labor market is moving in the right direction, and I think this is a really important part as we go forward. And of course, we've seen this phenomenon again, but I think there's a number of factors. I think income and employment and confidence, these fundamentals today, I think, are stronger than they were a year ago. And hopefully we don't hit any speed bumps like we did last year. When we look at retail, I know there's some retailers out there. Actually, retail employment is around 15.4 million jobs. We haven't regained all the jobs in the nation that we did prior to the recession. The question will be, will we get them all back? Largely because the question would be is how much is electronic commerce taking, and do we need as many employed? And we've seen it in certain brick and mortar national stores that they've had to adjust their employment size based on where people are shopping. And to that extent, there was actually 550,000 jobs open in the retail industry in August, and about 580,000 jobs, 500,000 jobs were open in the retail industry. Now, that doesn't mean they're all getting hired, but they're opening. And it's also the same issue with other industries, is getting the right people, qualified people. And you would think, well, what do I got to worry about in retail? Well, I think it's a misunderstood industry in some cases. It's not always these, low-paid jobs without any skills. There are many jobs in retail. And today, the sophisticated consumer comes in, and you have to be able to understand their wants and their needs and how they're going to get fulfilled for that purchase. So I think there's some misunderstanding, and some myths. And to that extent, I think that as, it's the first line. When you think the economy's growing, where do you first see it? Often in retail. So what I've done here is shown sort of our total openings against our growth in retail over the last several years. Now let me turn to a wealth effect. This is a concept that may not be as fully understood from an economic science as you might want it to be. But our wealth has increased and our balance sheets have improved since the recession. So as my 401k grows or my stock portfolio grows, how much of it has been incentive do I think about spending? Or, likewise, as my home price increases, do I feel richer? Do I feel wealthier? And how much might I spend? Because I feel that my net worth has improved. And this is an important concept because actually the term marginal propensity to consume, so what percentage of the additional amount of value, either in your wealth or in your house, will I think about spending today? And the studies show between 6 to 9% will go up, 6 to 9 cents of every dollar will go up in the first year if you see your price of your home going up. And other studies show that when your equity market goes up, not so much happens. And why is this important? Well, you know, for most of us, most households, 70% of households own a home. So it's a very important part of their net worth is how their home is doing, how their home value is doing, and that has a very important part to play in terms of consumption. And so as you think about it, this is one of those areas that we don't have as much science we would like, but it is a factor, and we have to kind of guesstimate on how much this will play into the everyday spending patterns that we are observing. Now, I talked about a housing recovery, and we've been seeing it, but it's been very sporadic, to say the least. These two lines are existing home sales, single family, and new home sales, single family. And we saw a breakout in August of new home sales jumping 18% to about 504,000. That's that red line. Yet existing single family has broken out of its slump, but it still kind of took a little bit of a backslide in the most recent period. But it seems like we're getting back on trajectory. What's happened? Why did this jump that occurred in 2013 and then the backsliding going into 2014? Affordability is up, but people qualifying, and there's issues regarding your credit, and also in late August or so, there was a concern that the interest rates for mortgages were going to go up, as Bernanke had been talking and communicating that, well, we might be doing certain things, and that it also all quickly got translated into that 10-year going up. Since that time, the 10-year Treasury has come down, and many mortgages are factored off of that. So the long and the short of it, as I think about housing, it's got to play a role. It's got to play a role and will play a role going forward. And as I mentioned in that forecast chart, is expected to play a role into 2015. And so what caused the housing market to perform below expectations this year? Inability of buyers to qualify for mortgage credit. That's 65% of the panelists cite the inability to qualify for mortgage credit. And then you include decline in preference for home ownership. That's another factor. As we think about household formation, and I'm sure Jeremy looks at it very closely, household formation is a key factor that has been retarded in this recovery. I have kids that are still living there out of college. They lived with me for a while until they could no longer put up with me. But think about it from a retail standpoint, they're not buying detergent, toilet paper, and all the other activities that if they were on their own and renting a place, that would be the products that they were going to need. So in some ways we've become economical, but in some ways it's also been a deterrent when we need this home ownership, and actually household formation includes renting and also home. And I think that's going to hopefully we'll see some traction this past year as we see more jobs come online and people getting a little more comfortable. So let's talk a little bit about inflation and public policy. I skipped over investment. I said I was because really investment, as I mentioned, in terms of spending for structures and equipment and for software. It's been a missing link, although equipment and software has been propelling forward. We need more opportunities for business to feel good about expanding. I know that's a very important part of your economic development strategy. And as you look at actually borrowing of money and growth in jobs, they go hand in hand. They're highly correlated. So if investment does pick up, I think it'll help, along with housing, to give us that level of growth that we're looking at to that, that 3% GDP growth going into 2015. Consumer prices, I kind of mentioned a bit ago, year over year, it's been up about 1.7. And then if you take out food and energy, it's about 1.7. So long and the short of it, it's been stable. It's well below the Federal Reserve's target rate, and that's a good thing. And if you start looking at some specific items, this has been a challenge, especially in retail. Apparel has been generally flat. Clothing prices, generally flat. Where most of the price level changes are occurring are in services, not in products, the durable goods and non-durable goods that you're purchasing. It's mostly in services. And certainly, as I mentioned, gasoline, I think, will make a big difference in the near term in where oil prices go. The Employment Cost Index happens to be one of the indexes that comes out irregularly, but it is probably, in my view, and for many economists, a very important gauge of the true inflation rate in the economy, cost of wages and salaries and compensation. And so we haven't seen this, and we won't see the third quarter report until October 31st at the end of this month. The blue bar is compensation, and it certainly has rebounded in the last quarter, up 2%. That would be the second quarter, after dipping about 1.8% the prior quarter. And you can see different parts of the economy have different paces. And so the nature of wages and salaries really reflects, in my view, the surplus labor market, the surplus in the labor market. And without normal nominal wage growth, I don't think inflation is going to be an issue for the near term. So don't expect this to be a big concern throughout the rest of this year or next year. Next question is, when will the Fed raise rates? And my forecast is somewhere around June or July next year. I'm in the middle group, that second quarter, 2015, and about 69% of them suggest that it'll occur between the second and third quarter. From that extent, what does that mean from Fed funds and Treasury rates? Fed funds don't really change for you finance types, meaning the second quarter is when the Fed probably will begin to change those rates. And then what does it mean from a standpoint of the 10-year yield? Let me just quote a couple of numbers for you. We're looking at about a 2.8 10-year yield at the end of this year, probably about a 3.5 10-year Treasury at the end of next year. I look at another set of data. If you haven't looked at it, I think it's fun to look at it. There's an index called the Policy Uncertainty Index by Scott Baker, Nick Bloom, and Steve Davis. And it kind of looks at what's going on in terms of newspaper coverage of uncertainty and disagreement among forecasters as to where the economy is going, as well as other issues. And they tabulate this on a regular basis. And so, looking at this chart, uncertainty seems to be a little bit low, and our spending seems to be going up. So we get more uncertainty, it affects our outlook. And so that's my end of my talk. Basically, I think the outlook looks like it's improving. Our fundamentals, as I mentioned, in terms of consumer and business investment should help us going forward. Labor market continues to improve. I don't think inflation is going to be an issue for the near term. Spending on structures, I hope, will get going. And certainly one part of this equation I didn't mention, I should have real quickly, and I know I'm going to get the hook here, but the fact of the matter is government spending is lessening. On that one chart, we go back and take a look at it. It was a negative drag for the last couple of years. Going into 2015, government spending actually should be a positive contributor to economic growth. And with that, I'll close, and thank you again for having me here today.